Welcome, Real Estate Hustlers Podcast. I'm your host, Josh Appleman. Today we are joined with Josh Perizzo, a rising force in apartment and RV park syndication, blending sharp analysts with authentic connections to build lasting investments. Josh, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Sure. Yeah. First off, thanks for having me. Yeah, I'm Josh Perizzo. So I live in Lake Elmo, Minnesota. It's about 20 minutes east of St. Paul. I live with my wife and our newborn baby. We just had our first about 7 weeks ago, so we are in the throes of it right now. But it's been great, very busy. But yeah, I started real estate about 2 years ago. My position at my W-2 job got eliminated, and I found a new job. And in between the two, I took about 4 weeks off, kind of to find myself, find what I really want to do in life. And I was working on some projects at home. I think I was actually painting one of our bedroom walls, and I started listening to audiobooks. Specifically, Rich Dad Poor Dad was the first one that really opened my eyes to what we can do in terms of generating income besides just a normal W-2 job. And that's what really sparked my interest in finding different ways to make money. And I kept on reading books. I found another one that was about investing in apartments specifically and doing apartment syndications. And that's when I had the eureka moment of, okay, I think I want to try to do something with real estate and investing, and specifically, scaling to bigger properties than just a single family home. So since then, I've done a mentorship program. I've been analyzing deals and doing everything that I need to do. We just closed on our first deal earlier this year. And now it's me and my partner. We're just scaling and looking to close on the next deal before the end of the year.
Nice, very cool. Where were you at when you first got started with real estate? Did you have your first property already as far as what you're managing, or was it straight just scratch?
Yeah, it was unique that I just went in head first. A lot of people that I talk to, they buy a single family home or a duplex and they start in that aspect. But my initial goal was to buy one single family property every year for 10 years. And then I did the math. As long as no major maintenance issues came up, that would be enough cash flow to kind of do that full time, right? And then I started to look into, okay, how do you scale this thing a little bit faster? And once I found apartment syndications, that was, like I said, that was the light bulb moment. So I jumped in head first into going for bigger properties.
Got it. Very cool. Well, let's talk about your first big property, how you found it, how you underwrote it, and how you closed it, and the business plan.
Yeah, so I met quite a few people through my mentorship program, and one person in particular, my partner today on the project, he lives about 2 hours west of me. We're both in the same state, and we hit it off in the group. And he was looking more in tertiary markets. I was looking more in the Twin Cities area. And we worked together to find this property. He had a broker relationship, and it was in Alexandria, Minnesota, which is a small lake town. But he brought it to my attention at the end of the year, and we did some more underwriting together. And it turned out to be a really good deal. It's a 23-unit apartment, and it's a 40-lot RV park, which I wasn't planning on doing a campground or anything like that, but it was a package deal. So we did the underwriting. We went through different scenarios of, all right, if vacancy was at X, how could we do this? What would the IRR be for our investors? We went through different scenarios of our returns. And after doing some serious underwriting, we did come to the conclusion that it was a good deal at the purchase price. Put in the offer, and we got the property, and we raised the capital. And now we're in asset management mode. The business plan was to take some of these units, renovate them, and get those rents up to market. And that's exactly what we're doing today. And the RV park's just a bonus. I mean, that's been going great. We've far exceeded our revenue numbers for year one, and we're growing it like crazy. So it's been really successful.
Okay, so you've got it under LOI, and then I'm assuming you did a property tour, you did your due diligence. Tell us about that process.
Yeah, it was my first time doing a legit property tour through each unit. And this is a Class C property, so we had a mix of tenants, right? Some units were looking good, tenants were great, and some, they needed some serious work. So that was the big what if with this property. It's these units that really need a lot of work, and these tenants are, we don't know what to expect with the tenant class. We walked through each of them, and I mean, at the end of the day, even at a high CapEx number with some of these units, the deal still made sense. So we
What is
walked
that
away.
high CapEx number?
So originally we were looking at anywhere from, 3 to 5,000 a unit turn, no major renovation, but even if it were up to 10,000, which I know in some markets is a very low number, but for this specific market with this type of property, that was very high. We ran through those scenarios, and even at that number, raising a little bit more capital, the deal still makes sense for our investors. So we definitely wanted to move forward.
Got it. Okay, so you're in due diligence. You're finding out how much the capex budget's going to be. Any inspections? Anything? Any unknowns that you've scoping the pipes, plumbings? Anything that?
There was a few different things. Foundation was a big issue. Actually, it was bowed, and that was going to be a big expense. But after we found that, we went to the seller and we said, "Hey, this is not planned in our budget. We can't move forward with the property." So we were able to negotiate that the seller pay in full that foundation fix, and we were able to move forward.
That's the cool thing is finding a balance because that way it's a win-win at the closing table. Because if you hadn't done proper due diligence, the issue is still there. Then you've got X amount out of pocket, out of closing, and then that lowers the returns for everybody. The what you don't know what you don't know, but due diligence uncovers hopefully 90%. So
Right.
very cool. What kind of debt did you take out, and then how much equity did you need to raise?
Yeah, so we did a local bank. We got the terms at 20% down. It was a 7.1% interest rate because it is a smaller market. And with that, the purchase price was 1.6. So we raised the 20%. And then in CapEx, we raised an additional 200,000. And then we had obviously the asset management fees, the acquisition fees. So bringing to the table, we raised about 500,000 in capital, which was a great first deal size for us, right? It's funny because when you first get into this, you assume that you can raise X amount of capital, but until you actually go to your investors and put pen to paper, it's a different ballgame, right? So I think that $500,000 was the perfect number that we were able to achieve it. And now we're building trust in these investors, and we can show, the next property investors that, hey, we are far exceeding our expectations in terms of investor returns. So it went really well.
Is that Josh, or is there other people behind you as well?
No, that's myself and my partner Zach in this project. Yeah.
How did you all? Because you all are new operators, new to the industry, new operators, no proven track record. So how did you hit the ground running to find investors willing to take the risk?
Yeah, that's a good question. So first things first, I went through my entire network, everyone that I know that I have phone numbers for, emails, anything, and I just did a huge spreadsheet and just started contacting people. Now, this is after I knew, what I was doing through the mentorship program, right? I didn't want to just start calling people before I knew what I was doing. But I started calling them, and I had kind of an example of a property that I was looking for, an example deal. And I told them, here's the metrics that I'm trying to hit for investors or limited partners. I told them a little bit about apartment syndication because many of them didn't know what it is. And we were able to raise some capital that way. And then I just started going to networking events. The biggest key for me is just meeting whoever you can, even at random public places, just striking up conversations. I've never been the type of guy to be very outgoing, but I'm doing better at just striking up conversations with people and bringing it up whenever I can. So
forcing to be an extrovert.
Yeah, exactly. Right.
Finding out what do you do for a living, and you look like my avatar. That's cool.
Yeah.
And that's truly the grit and the hustle that it really takes in any career, any industry. It's just those that are willing to do it. They make success the only option. So That's cool. Hats off. And it doesn't seem like a lot, but $500,000 or $600,000 is a lot when you're truly starting out with no track record and no deals behind you to prove that you can truly do what you say you can do. You got to have the deal, but the saying that the money will come if you have the deal, that is so false. It's unbelievable because it could be the greatest deal in the world, but you still have to have the selling point that the operator's not going to ruin a good deal.
Right.
So
I think the other thing too is that to a lot of people that have never heard of this, it's very foreign. So building their trust in something that they don't know about is huge. So teaching them what it is in a way that, is not going to scare them away was huge for me, and learning how to navigate that, right? Because people just see this and immediately they say, no, that's not for me, right? So being able to navigate that has been huge.
Yeah, very cool. So you've got you did your due diligence. You started raising capital. You've got your lender, which is local lender. Regional banks are great to work with. They get the insurance play. They understand it, and then you got to make a compelling argument that you're the operator. Which are you all managing it and operating it, or do you have third party in front of you?
We have third-party property management. Yeah, and that's
Okay.
for the apartment and for the RV park. I
Okay.
live
So
about
you
I live about
you
2.5
leverage
hours.
their experience to help get it closed too.
Yeah, for sure. I mean, we went through and leveraging their experience of the rents. What do we realistically think we can get them to if we do these types of renovations at time of exit? What do you guys think? In terms of exit cap, I like to be conservative in that aspect, but just really leaning on them too, and they've been great to work with.
So one thing that I did when I first started out, because of course everyone starts out at somewhere and it's always zero, but I started an account with Buildium, and Buildium's a property management software. So they were using, I can't remember, but we'd pull reports and we would actually put our financials in Buildium, and we would just mirror rents collected and tracking our T12. So month over month. So I would have a full operating set of books where you log into their system, you can only pull reports, versus mine, you can actually see true data. So
Yeah.
just mirroring what our financials that we were getting month over month, be able to reconcile, and then really seeing a different light. But we were doing that for a couple of years, and then it got to a point where it was ready to take it over on our end of operations too, because you'll get to a point where you need more control over everything, especially if you're going in, you're renovating, you're leasing it, you're doing all of the armpit work anyways, and then you want to totally control your financials and your spending. But having that functioning system already in place, it wasn't starting over. It wasn't starting from zero, because we were already used to the systems. So
Yeah.
just for the listeners that are new to it, that will eventually get to an operator, that's one method that we used, which helped. On the RV side, what are you seeing? How are you seeing that go?
Yeah, that one was very new. I mean, we kind of had to relook at how we underwrite this thing. I mean, we can use the same basic principles, but it's a campground and it's basically, short-term rental, right? Because there's people that are just coming in for a weekend, they're doing nightly stays. So underwriting that and forecasting what we think we can get in terms of revenue was a completely different thing, right? So we went super conservative with the numbers in terms of what we think we'll get year one and so on. We took what the previous owner had gotten the previous year, and they weren't on site. They were just kind of running this thing, from a different state, and they didn't get too much revenue, but that's the number that we plugged in for year one. We assumed we could get higher by marketing, really going out our way to make this thing better, but we plugged those numbers in. And like I said, we far exceeded that by using social media platforms to market our RV park. We've went in and also applied some CapEx to that, fixing things up, making sure it's a nicer place for people to stay. And yeah, we are happy to say that we've already hit pretty much our year 5 target of revenue, and we're not even done with the season yet. So I think that out of the 2 properties has really been the home run for this deal, and that's just kind of the cash flow king for us.
What were the low hanging fruits on the RV that you all put in place that the other owners were not doing at all to boost revenue?
Yeah, we have somebody that's local now that can always be there to help guests when they're checking in. We just put new signage up. We made the check-in process a lot easier for guests. It's super straightforward now. It's all on an online platform. So I think it's just streamlined for guests, and then putting it in front of them with social media platforms. We're doing what we can to market. We're going to different businesses in the local area, just trying to promote it wherever we can. And that's been really a huge success for us.
Very cool. Good deal. So you have multifamily and RV on the one property, and one supports the other. Is
Yeah.
it in an area where it's just year round travel, or as far as RVs go?
No, not year round. I mean, in the wintertime, we're closing it down. I mean, it gets frigid cold here in Minnesota.
Got it.
So we are trying to look into maybe, storage, outdoor storage for RVs for the wintertime. We're trying to really think through how can we continue to generate revenue throughout the winter months. But like I said, we're just looking at the summer months for revenue, and we've hit that target.
Plug that in ChatGPT and see what it uncovers.
Right. Seriously.
What would be the other property that you all ended up purchasing?
So that's a 24 unit apartment complex. It actually used to be one resort, and they converted the resort side of it into an apartment complex a few years back. So we purchased that. And that one, like I said, it was a little bit more of a Class C. Definitely needed some work. Vacancy numbers were good at time of purchase, so we just saw the opportunity to go in and do some work on the units, not make it anything crazy like a Class A, but just clean them up a bit, make it a little bit nicer place to live, and then hold for 3 to 5 years and exit when it's right. And we actually want to split the two assets, so we want to hold on to the RV park if possible to cash flow, and exit at year 3 to year 5, get those investor returns back, and then we can hold and just cash flow.
Yeah, get the NOI stabilized and maybe even go in for a credit line to get them made whole, and then sell or refinance the whole thing. Yeah,
Yep.
hold forever.
Exactly.
So what kind of underwriting are you doing? What are you looking for?
Yeah, this one, I like to see a good DCR from day one, right? If we're going to the bank, we need to have, I'm looking at least 1.25, but it depends on the type of property, right? If it's a true value add, we're going to go in and understanding that we really need to put in some work to get that NOI up. But we want to buy something that's cash flowing from day one. This property was that, but it did have that value add, play as well. So we went into this. I always want to have something cash flowing. I like the thought of a big IRR, but I like the thought of cash on cash even more. And I think my investors, especially, they like the thought of being able to get their cash flow annually. So we went into this. We saw that, they were operating it okay, but we had a lot of fixes that we could do in terms of revenue, gross income, and then some of the expense numbers that they had were pretty darn high, especially maintenance. If we go in with CapEx and really fix up some things, long-term fixes, instead of just trying to put a Band-Aid on some things, we could get those maintenance numbers down. So that's kind of our plan. Our NOI year to date has been, exceeding our year one analysis as well. So we're doing good.
Well, that third party property management, they have to be on board too with your plan. So how has that been going?
That's been good. Actually, they are the ones that have been helping out with the renovations as well. So they've been a key player to all this. Sometimes my partner and I, we'd like things to move a little bit faster, or we have the business plan locked in, and they've been pretty busy. But overall, it's been a really good partnership with them. It's just navigating that dynamic with a third party property manager, because they have other properties to look at too. So making sure that they know the exact business plan, our timeline, our budget, and them sticking to it has just been the main thing.
Yeah, it's how far are you all from the property?
About 2.5 hours.
Okay, all right. So that's hard for you all to bounce in and out as assisting project management.
Yeah.
Because that's one of the biggest leaks to cash in general is labor and material purchasing and procurement. It's just finding the local resources and then being savvy with your purchasing on where it's coming from.
Right.
So are you just giving line item budgets for renovation materials to them,
Yep.
and they have to go find it?
Yep, pretty much. We're working together because they're getting estimates. They have relationships where they buy in bulk for other properties as well. So we're kind of going through, and they're giving us estimates of materials. And then as long as it's hitting what we're looking at, we're going through line by line, giving them a budget. And they're also giving us estimates on units based on, where they're at, how much material they have on hand, or how much did they purchase it for at the time, right? And then their labor estimate, what they think it's going to be. They're just plugging in their maintenance labor hourly rate, and they're dedicating one employee to fix up these units.
Got it. Maybe a weekend road trip until renovations are done to inspect and sign off
Pretty
on the
much.
units.
Yeah, or maybe stay at the campground and kind of keep an eye on things, right?
But it's your investment. You're the jockey on the horse. So if not, then who? And I can tell you, they don't care as much as you do.
Exactly.
So kind of a duty and responsibility, but it's all one-time things. So it's not something that's going to continuously come. It's one-time things that you just have to get through, and next year and the following years it'll be worth it.
Right.
Especially the quality piece. That is truly the armpit of the business is the labor and making sure that it's all getting done to expectations.
Right.
Cool. So what does the future hold? What are y'all looking at the next deal?
Yeah, I mean, lately we've been really building relationships with specific brokers, especially after getting this deal done. Once we could prove that, hey, we can do this, it kind of shifted the way that brokers approach us, which has been great. So we're building relationships with a few different brokers around the Twin Cities and then tertiary markets in Minnesota. And I'm also calling owners directly to build that deal funnel. So the hope is to get another deal done within this year. And we're kind of looking at that 20 to 50 unit range based on the price per door. Here in Minnesota, that can be anywhere from 80 to 120. And we're already working with investors. We're building our capital pool, which has been great. And like I said, it's just finding that specific property that hits our return metrics, using our specific underwriting style, exit cap that's higher than the time at purchase for the market. We have to be conservative, especially being newer. We got to make sure we get these investors their returns. So we are taking our time to make sure we get the right property.
Yeah, I'll tell you one thing that I like to do. It's not a requirement. It's not even anything. It's just going more of a integrity thing. Going above and beyond is sending just a weekly email to the banks. If you don't have investors, you don't have partners, just send at least a weekly progress update to the bank, to the point of contact. Especially if there's funds that need to be drawn down for the renovations. But they like seeing updated pictures before and after and during, and then having a separate G Drive folder with renovations before, during, and after, along with the rent roll. Again, it's just being who you say you are and doing what you say you're going to do. But it's trust is based on performance. So here's the performance, here's the pictures, and that builds trust on its own too. And it's keeping the bank is your partner, so keeping them in the loop and letting them know that their assets being taken care of, and it's a partnership. So that's helped. That helps portfolio growth down the road as well.
Yeah, that's great.
Very cool. What would be some advice that you would give for a new real estate investor looking to break in?
Yeah, I think it can be pretty daunting, especially as you look at everything that we need to know and do and the network that we need to build. I think, first of all, knowing what you're doing by really learning from someone that's done this before, that has the tools in place. I mean, that's number one. You got to learn everything there is to know. Obviously, you learn through doing as well. My partner and I were learning through this first property, but knowing the ins and outs enough to be talking to professionals in the industry. But once you know what you're doing, it's just taking it day by day and creating action items that are achievable for that day. I think I remember taking a step back and looking at my goal and, feeling very overwhelmed. But if you just take it one step at a time, contact this broker, contact a property manager, set up a meeting, underwrite X amount of deals, and just take it in that way. It will come. You have to be patient. You have to work hard, but you can do it.
Yeah, 20 units seems impossible when you have zero, and then 100 units, and then 200, and then 400, so on and so forth. So, but yeah, like you said, you have goals, and as long as you have a goal, then you'll eventually get there. Very cool, Josh. Definitely appreciate your time. If somebody wants to reach out, learn more about yourself, learn more about your organization, possibly invest with you, how can they get a hold of you?
Yeah, so you can send me an email. It's josh@magnavistacapital.com. That's MAGNIVISTA capital. You can add me on LinkedIn, and we can chat on there. Both of those ways are great ways to reach me.
Cool, Josh. Definitely appreciate your time today, and look forward to following your